zoom out, remove the noise. If tomorrow is not going to be more digital than today, then start worrying. You can also worry at some point about the big cycle. So 2026 is likely to be a down year. Will that happen? I don't know. Most likely. Now, you can either hold on through the down years and keep adding and increasing the value of your portfolio, or you can unload some risk. The time for lifestyle chips are somewhere between December and March. We will obviously get more volatility in the space. Expect 30% pullbacks frequently, maybe 35%. These will happen. Maybe Bitcoin goes to 100,000 and then pulls back to 70,000 and goes up. Don't freak out about it. It's really normal.
Zoom out and cut through the noise. Today's pullbacks could set the stage for massive gains tomorrow. That's the latest insight from Raoul Pal, CEO of Real Vision and a veteran macro analyst. In a recent update, Pal shares key strategies for making the most of this market cycle and avoiding costly mistakes that could cause investors to miss this rare opportunity. For him, restraint and strategic planning are far more powerful in building long-term wealth than chasing hype or reacting impulsively to short-term market moves. Success comes from playing the long game, not catching up in daily volatility. Stick around as Raoul Pal shares more essential tips on how to seize this once-in-a-lifetime opportunity without making critical mistakes. Oh, and before we dive in, if you enjoy staying ahead in finance and crypto, consider liking and subscribing. It's free, and you can always change your mind later. Now, let's hear from Raoul Pal about how to make the most of this bullish cycle.
The other key thing, the actual real hack to all of this, is just hold for a long time horizon. Just holding means you don't do anything. It's very difficult to make mistakes. You're self-custodying, you're not trading, you're not trying to scalp anything, you just hold it. And guess what? Over time, Bitcoin's done about 150% a year, including 3 kind of 70-80% drawdown. By doing nothing, you just compound the returns over time. I like to add to my bags into the big cyclical sell-offs, that once every 4-year down cycle. I like to add, and then your holdings compound and you make more and more money each time. But just have a longer term time horizon. For sure, look at the hourly charts. It's fun. I've got them up all of the time, but I don't trade them. I just hold. I barely do anything. I make a couple of asset allocation switches in the entire cycle, and that's it. And magic happens, and it stops you up. So try your absolute best not to do anything with your main holdings. Also, zoom out. This space is all about noise. It's called FUD, fear, uncertainty, and doubt. You'll find that somebody somewhere is trying to scare you, telling you it's a scam, telling you it's going to collapse, telling you something is going to happen, the Chinese are going to do something, the Russians are going to do something, something's going to go to war. All of these things are going to come across your screens every day, and they will make you feel insecure. Remember, this is noise. This is an adoption of technology. And if tomorrow is going to be more digital than today, we will use blockchain rails for proof, for social proof, consensus proof of value, of transferring assets, of holding assets. Everything in a digital world is going to require blockchain rails. It'll be equity markets, bond markets, currency markets. It'll be art. It'll be tickets. It'll be anything. Any contract is better on the blockchain because you don't need a trusted third party because the consensus mechanism allows everybody to trust it. So over time, the adoption of Bitcoin is huge. In fact, it's still growing at twice the speed of the internet. Back when the internet was in its early days, something that grows at that speed also goes up in price. So zoom out, remove the noise. If tomorrow is not going to be more digital than today, then start worrying. You can also worry at some point about the big cycle. So 2026 is likely to be a down year. Will that happen? I don't know. Most likely. Now, you can either hold on through the down years and keep adding and increasing the value of your portfolio, or you can unload some risk. And we'll talk about some of that. Don't forget, en route, make sure you take some lifestyle chips off as well. This is a really important concept. I've got another video on this, but lifestyle chips are the ability to take off some profits in things that really matter to you. So if the markets turn around, you don't time the top properly or whatever you're trying to do, you've paid off a mortgage, or you bought the car, or you bought the holiday. You've done whatever it is that you need for your own life. And you're going to hate selling out when you have to take some lifestyle chips off. But at the end of it, your future self will thank you massively. So make sure you think about that. The time for lifestyle chips are somewhere between December and March. We will obviously get more volatility in the space. Expect 30% pullbacks frequently, maybe 35%. These will happen. Maybe Bitcoin goes to 100,000 and then pulls back to 70,000 and goes up. Don't freak out about it. It's really normal. But remember to take some lifestyle chips off at some point. And the other thing is buy the dip if you can. So if it does sell off 35%, you've got a bit of extra cash, buy it if it's not the end of the cycle. If it is the end of the cycle, then you wait till it goes down 70% or so, and then you pile in as much of your savings as you can on top of your existing holdings and let the magic compound over time. Let me tell you a little bit about that, because I've learned that the hard way. So the mistake there was I bought Bitcoin at $200 back in 2013. Amazing. I then rode it all the way down 85% because I knew it was a long-term bet. It then went back up in 2017 and it was trading about $2,000, and there was some FUD, the forking of Bitcoin into two different Bitcoin blockchain. And I was like, I don't really understand what's going on. And so I sold out. So it was the FUDs that got me, and I then had sold out. But I was pleased. I'd made 10 times my money. Great trade. And I thought, I'd done it well. It then went up another 10x in the last 5 months of the year, which was unbelievable. I've never seen anything like it. I missed that, but I was fine because I'd taken money off the table. I'd taken my lifestyle chips out. So I felt pretty comfortable. The market then falls all the way until 2019. So that was the down year of 2018. And 2019, I started looking at it again. And really in 2020, during the pandemic, when it fell 50%, is when I got back in. I think I averaged in about 6,500, and I'm still long to this day. Okay, so that looks pretty good. I bought it cheap. I sold it expensive. I bought it back cheap. But when I looked at it, and I bought a lot more at the end, the second time around in 2020, when I go back and look at, if I just held my original bet, which was much smaller, I'd have made 5 times the money from trading it. You see, that's the issue here. Now, had I listened to myself and bought the big sell-offs and doubled up my position every 4 years when we had the down cycle, I'd have 25x'd my position. And again, you can only do this in the very top tokens, mainly Bitcoin, but maybe Solana, Ethereum. But really in Bitcoin, that's where you can do this very long term, because Bitcoin is much more secure as an asset over time in terms of its adoption and acceptance at large. Then you can diversify out into riskier stuff. But buying the dip would have made me a fortune. The FUD cost me money. Trading cost me money. I didn't do the hold. You see, so there's a number of ways you can lose your tokens. That's when an exchange goes down. Or you start using DeFi and you put your money for a yield into something, which is what people did in Terra Luna. And again, I did not do that. Or BlockFi or Celsius or all of these things. Everybody lost money because they parted with their token. Storing in the wrong exchange. OGs remember Mt. Gox. They still have been paid out. That was, 10 years ago. So that's why I don't like to keep things on exchange. Hold on, let the gains compound. I've also screwed up by having this big diversified bag where I thought, all of my tokens will go up, and I tried to asset allocate. That screwed up, and I've got a wallet of shame like most of you have. And that failed. A lot of people have got wallets of shame from the NFT craze in 2021, and many of you will end up with a wallet of shame from the meme coin craze. So in meme coins, keep it to a small weighting, please. It's great fun. Get involved. But if you've got too big a weighting, you risk losing everything. And then you with rule number 1, which is don't lose control of your tokens.
Bitcoin is staying strong even after a 2.6 billion options expiry, showing no signs of slowing down on its journey to 100,000 and higher. Some market watchers were worried this expiry could push Bitcoin's price down, but so far, it's holding its ground. Before the expiry, Bitcoin hit an all-time high of $99,523, but dropped slightly to around $97,805. These kinds of movements are normal during big events like options expiries. Options are like contracts that let traders buy or sell Bitcoin at a certain price. The market can feel shaky when they expire as traders adjust their positions. But all in all, experts believe this expiry won't stop Bitcoin's rally. Now let's go back to what Raoul Pal has to say.
So this tweet says, remember, no leverage. So what that means is if you start borrowing money against it by using perps or other means, you have a risk of losing your coins if you get something wrong in a pullback. And then if you lose your coins, you're out of the market and you have this up. So please don't use leverage. Leverage is for experts and shorter term traders and people who really know what they're doing. Even then, I personally never use leverage. My job is not to lose my coins. Secondly, no FOMO. That's the fear of missing out. You see, when things get crazy in crypto, somebody on Twitter or one of your friends will be making more money than you. In fact, it looks like everybody's making more money than you and you don't have the right trades and you're feeling terrible about yourself. That is just the engagement trap that is Twitter or the boasting of your friends. You don't get to see the trades that aren't working for those people. Now, really what it's about here is not doing stupid things. So not suddenly FOMOing into a trade because something else is going up more than your coins. That's an easy way to lose money because you end up usually getting into a trend too late. It then reverses. You've then lost money that you then try and get back into your old trend, your old trade. That starts outperforming and so on and so forth. It's a mess. Don't do it. The other really crucial one is only have 3 to 5 of the top assets in your main holdings. This is to de-risk. You see, the space is going to go up plenty. You don't need the fastest horse in the race. You need just good, fast horses. So for most people, just Bitcoin is good enough. Or maybe you want Bitcoin and Solana, because Solana has been, the blockchain with the most network adoption this cycle. Or maybe you have Bitcoin, ETH, and Solana. And then maybe you want to go a little bit further out the risk curve, whether it's SUI or Celestia or Say or whatever that one is for you. But remember, don't have that as your main holding because again, we don't want to f this up. And the others are proven over time. They have Lindy effects. They survive. And I want you to survive. So don't have this broad portfolio. Now, I've done the broad portfolio trade as well. And I f***ed that one up. So last cycle, I started off thinking, I don't know what I'm going to do. I'm going to buy a large basket on top of my Bitcoin holdings. So I had Bitcoin and then I had a large basket of 10, 15, 20 different names thinking, well, these will work over time. My basket should work. It ended up being a wallet of shame. Most of those didn't work. I got a couple right, but they didn't really pay for the losses. It left me unfocused. I wasn't focusing on what really mattered. And it was my Bitcoin bet and then my switch into Ethereum. That was a big bet. But that wallet of shame is something you'll all go through, but try not to do it. Try not to go too far out the risk curve into mid-size and smaller caps and hold a big basket of those saying, well, the AI theme's going to play out and the meme theme's going to play out and the real world asset theme's going to play out. I want an allocation to all of these. It generally doesn't work. Honestly, it is not easy. So don't try and be a genius. Just let the secular bull market rise the value of your wealth. That's what I'm trying to do here.
Raoul Pal urges investors to stay calm and ignore the noise. Crypto is full of scary news like FUD and hype, but he wants everyone to focus on the bigger picture. Digital adoption is growing, and blockchain is becoming a huge part of the world economy. He believes this cycle is a chance to change lives, but only if people stick to smart strategies and don't let fear or greed get in the way. Before we go, if you want to stay most up to date on the crypto and Bitcoin world, subscribe to my daily 5-minute crypto newsletter. It's a concise resource for the latest expert predictions, breaking news, and top on-chain analysis, trusted by over 50,000 subscribers for insightful crypto investment information. Don't miss out on the opportunity to stay informed in the crypto market. The link is in the description below. I hope you all enjoyed today's video and that it gave you some value. I'll see you all at the next one, and as always, all the best.